This conference will now be recorded.
All right, let me go up here. I got most of those tickers that y'all put in the chat. I will get to those as we go through this. Let me open this up. All right, this is Greg Morton. It is Tuesday, May 11th, 2021. This is the monthly online meetup for the Greenville Eastside IBD meetup group and the Stockyard online meetup group. So I welcome you guys. We have a pretty full agenda tonight. I'll look at that as we go through this. Also, you can type questions in the chat. I will look at those between each section, and we'll also take a break 1 hour into the meeting, take a 5-minute break. So I'll look at them then. My friend Michael Harris will be helping answer questions as he always does. Michael told me this week, I didn't realize it. He's been with my meetup since it started in 2015, and he'd only missed one meeting when he had the flu one month. So special thanks to him. That's why he does such a good job answering questions, because he knows what I'm going to say. Steve Sweats may show up. Richard Moglin may show up. So y'all can ask questions. Try to keep them related to what we're talking about. It's distracting to everybody if the chat goes too far afield. And then Michael sends me a printout of it later so I can double check it and/or just follow up with everybody if there was some good question in there that may have been answered, but I might want to expound upon it a little bit. So thanks to those guys for helping me out there. As always, standard disclaimer, educational purposes only, hopefully highly educational, not recommending any stocks or securities to buy or sell. And we all know, particularly this year, all investing has substantial risk of big losses. So we want to learn first and only then invest. So administrative matters, I think most of y'all were familiar names. 2 meetup sites. All the resources are uploaded on the Greenville Eastside IBD meetup site. I'll remind you of how to get there. That includes the coloring book, the group teaching portfolio, and just tons of Can Sllim material that I accumulated over the years when I was trying to find things. And so I've just uploaded it and given y'all links to a lot of it. So take advantage of all that. And my normal goal, I want to provide primarily intermediate to advanced Can Sllim education and skill development. Sort of a college level is how I view it, and hopes that y'all learn something practical or something new as we go through the material. I think we've got some good stuff tonight. Other administrative notes, y'all can look on the meetup site and see whether or not you're registered. I don't have access to your email addresses unless you email me directly, or your private financial situation or information. That's all handled through Meetup and PayPal. I still have a few people that have email issues, but we're getting that narrowed down. In other words, they don't get the messages when I try to contact all attendees. And then you'll go to the More tab and message boards on the Greenville Eastside site. Let me go back. Maybe I need to try and remember how I mute everybody. Sorry, I lost that tool. If you're not muted, if y'all just mute yourself till we get to later in the meeting, that'll help, just so we don't have any background issues. They move these tools around, so sometimes I can't find them. Okay. And then I send out the access email 24 hours before the meeting, and then usually get the recordings and slide decks out within 24 hours after the meeting. So if you don't have those, just follow up with me by email or message board on the meetup site. So here's our agenda for tonight. I'll do a brief Can Sllim overview. If you're new, you can reach out to me and I'll point you to some other resources that I think are very helpful early in your Can Sllim journey. We'll look at the M factor like I do every weekend. I think a lot of y'all watch that. Educational topics for tonight. We're going to talk about when, why, how, and what. We'll delve in a little deeper on ETFs for Can Sllim investors. We're going to look at the I in Can Sllim. I'm actually going to flip the order. We're going to do the I in Can Sllim first. And then if we have time, I'm going to talk about the wash sale rule, but I may bump that to next month also, because I want to get in some charts before the end of the meeting, and we'll start looking at stocks you all sent me tickers on. I'll have some IPO notes, look at the group teaching portfolio a little bit. I can pull up my watch list from last weekend, which isn't looking so hot. And then stocks the group picked, I'll do as part of the 30-minute Q&A. And like I said, I forgot to put it in there. We'll take a 5-minute get up and stretch break in the middle of the meeting because I need that and you all need it. Our basic definitions, if I refer to Bill, of course I'm referring to Bill O'Neill. The book is How to Make Money in Stocks. If I refer to his other books, I'll mention them by title. David Ryan, O'Neill protege, 3-time U.S. investing championship, and now he's showing up on IBD Live pretty regularly, I think once a month or so. Our Can Sllim portfolios, concentrated portfolio of equally sized initial positions, generally 8 to 12 total positions maybe. Might narrow it down the further we get into an uptrend. Can Sllim trading is position trading in growth stocks, not swing trading, not day trading, not value stocks. If I talk about IPO bases, I'm using the definition from the IPO home study course, which requires a left side high in the first 25 days of trading and then a short base thereafter. Normally 10 days is sort of the minimum length, but they can go as low as 5. I like to see at least 7 days in that IPO base. When we talk about scaling in, the group teaching portfolio, it's actually 60,000 is now a full position size. I need to change that. And then B1, B2, and B3 is what's in the book, 50% size at pivot plus 10 cents, 30% at pivot plus 2.5, I use 2%, 20% at pivot plus 5%, and I use 4% on the B2 and the B3. If we talk about add-on buys, we're talking about adding a certain percentage of the shares that we already held before the add-on buy. And then on all my charts, the moving average lines are the 10, 21, 50, and 200. They are all simple except the 21-day is the exponential moving average, and they are pink, green, red, and black in that order. So buying or initiating on strength, standard breakouts from full and proper bases, or early alternative entries, sloping trend lines, horizontal trend lines, shakeout plus 3, which we covered that last month. Buying initiating on weakness, it's kind of what Charles Harris does. The first one's Mike Webster's personality. Second one is Charles Harris, both successful portfolio managers, but different entry strategies. So he initiates more often on pullbacks to the 50-day or 10-week, which is very difficult because everything's going down when the stocks are hitting that. Selling in the strength is selling as it goes up, like honoring your 20% profit goal rule. Selling on weakness is selling sometime after it has topped, maybe on a short-term break of a moving average, or if you have a true market leader, we'd like to hold it till a break of the 10-week line on volume at the end of a week, since it is the 10-week line. And then, 40-week line, sorry. And then model stocks are 10-week, it would be the same on the daily. Model stocks, that's IBD, Bill lingo for the great ones, the true market leaders. It is not the same as long-term leaders. That's something new from IBD, and I'm really not covering that. It's a little bit different entry and holding strategy. And if you see the dots on my charts, here's what they are. It just helps me make sure I don't overlook really strong stocks. So for 4 green dots, you have to have triple-digit earnings and triple-digit sales growth in the last quarter. 3 green dots, triple-digit earnings growth, and Can Sllim, at least 25% growth on the sales side. 2 green dots, earnings at least 40% in the last quarter, sales above Can Sllim level. And that comes from a Bill O'Neill webinar where he said, let me make this simple for you. If that stock doesn't have at least 40% or higher earnings growth in the last quarter, it doesn't right now have the characteristics to become a true market leader. So that's where I got the 40% from, as being the trigger, and hey, I need at least that for the 2 green dots with good sales. 1 green dot is really just for IPO charts telling me it's profitable or not. Red dot's non-profitable IPO, but it does have sales over 10 million the last quarter. 2 red dots, no earnings or sales IPOs. So that's just how I sort them. Yellow dots, China or foreign stocks. Pink dots reminding me it's thin. And a blue square is 3/4 earnings and sales acceleration, which is rare. So this is also on the Meetup site, so you can review it. Brief overview, Can Sllim was developed by O'Neill, late 50s, early 60s. It's growth stock investing, it's not value stock investing. It's position trading, it's not swing trading, it's not day trading. It has specific buy and sell rules. That's kind of the key. Buy-in, we're looking really at 3 things. Fundamentals, which is the left side of the chart. And remember, this is weighted 2/3. Everybody forgets that. Everybody treats the fundamentals like they're weighted the same as the right-hand side technical action on the MarketSmith chart, and they're not. O'Neill says the fundamentals, the math, the earnings, and the sales are what drive a stock up, so he weighted them more heavily. Technicals are 1/3, and then market direction is the other 100%. So just remember, everything on the chart is not equal. There's stuff on the left that's more important than the chart pattern on the right. And I think that gets glossed over some on IBD Live too. They forget to look down there at the earnings and sales sometimes. And then our sell rules, 100% technical stock chart action. In fact, most leaders will still have very good fundamentals at the time they roll over. Case in point, Zoom, right? Numbers are still great on Zoom. If you look at it and thought that thing should be screaming higher, chart tells us it's time to be out of it a long time ago. And so that's O'Neill's system. And then Can Sllim is the 7 elements that the great model, the leading, winning, true market leader stocks had in common based on O'Neill's research when he developed the system. So our goal as Can Sllim investors is to identify and buy, scale into, like I talked about, B1, B2, B3, a Can Sllim stock, there's a lot in that has a prior uptrend of at least 30%. So we're not buying at the very bottom on the chart. We want to see that prior uptrend. It shows the stock can do it. Set up in a full and proper early stage base, normally prefer first or second stage bases. And then we want to see it break out on above average volume of 40% or more. And then we want to sell it properly on the downside, triggers our 7% stop loss, or the upside, hits our 20% profit goal. And then we want to be doing this 80 to 90% of the time with consistency and discipline. And the other 10 to 20% is the 1 or 2 out of every 10 stocks that has the potential to be a true market leader. So we're going to handle that a little bit different. And I covered that January, February, March. We walked through extensively, writing your own sell rule, and covered all those different sell zones and sell rules on the chart. So we want to swing at the strikes, to boil it down as Yogi Berra said it. Your resources, here's the main 6 books. I always say if you have a child or a friend or somebody that wants to know about investing, you start with the blue book, and then you can go to the orange and the green are basically the same. So just get the orange, it's cheaper. The green one has a little test in the back. And then Amy Smith's book actually also teaches the Can Sllim system woven in with the success stories that she gives us. And then the other 2 books by O'Neill are important also. So don't forget those. It's not like the orange book replaced all his other books, because these have good stuff in them too. Other books that I recommend, O'Neill's book on shorting. That's great to just to study to see what charts that are topping look like. Gil Morales's book, who he was back at IBD with O'Neill when this one was written. Darvis's book. I just stuck this in there. You can get a lot of them on used book sites, like if you don't have something on there and you have the rest. I mean, that's a great price on the shorting book. It has a ton of charts in it, $5. So this was off of like thriftbooks.com. Reminiscences, great book. Perfect Speculator, one I really like, and a couple other Can Sllim investors I know really like it. You can read the Taser one, same author if you want to, but the Perfect Speculator is the one that'll help you. A little psychology book, Kathy Donnelly's book on IPOs and really the life cycle of a stock is excellent. Candlestick charting, one of the main books on that. And then the 70 charts that Bill gave us, these are linked on the Meetup site as well as my Twitter feed. So this is kind of the model book he gave to the public. So you can print these, you can mark them up. This is mine. Mark them up in green and purple because they already have red and blue on there. So green's good stuff, purple sell rules are things to be aware of. So you can take those and have them printed and bound and have your own little model book stock book. Home study courses, I don't recommend these anymore. They don't give you the chart books with them anymore. Kind of griped at them about that. I don't get anywhere, but I continue to gripe. So used to, it's a DVD set and a great big chart book. So hopefully they'll bring the chart books back, or at least make them PDF files. Of course, the newspaper and the website. Leaderboard is a step between the newspaper and investors.com and MarketSmith. Kind of hold your hand investing. They give you marked up charts, show you when they went on, when they sold them, some entries, some alternative early entries on some of the other charts. So that's a tool some of you may be interested in. And then Market Smith, this was yesterday, I believe. I think I put a current one in there. Yeah, because we have 5 and 5 and we added one today, which is of course the premier tool and a fantastic time saver. Then IBD Live, what they've been bringing on more guest hosts, which is nice. David Ryan, Mark Minervini, Kathy Donnelly was on there the other week. So Charles Harris. Arusha is no longer at IBD. He's a portfolio manager with the part of IBD with O'Neill Capital, which is not being sold as part of the sale. So he's coming back some. So yeah, I don't know where else you can show up and type in questions to O'Neill portfolio managers or people that have been doing it a long time, and to hear from David Ryan, because he doesn't go out and speak that much. So it's I really like listening to him. I make sure I catch the recordings on those that he's in. Greenville Eastside site, there's the More tab, then go to message boards and you'll get to all the things in there. Richard does great interviews. You can follow him on YouTube. I'm supposed to be doing one with him sometime in the near future. We've done some of the preliminary work. Carl's weekend reports at tradeobjectives.com. Go to resources. He does just a weekly recap of the markets and the charts, which is very well done. I read that each weekend. These old Market Smith webinars under classics, those are all good. These 5 from LA are particularly good. Take advantage of those. Those are, even if you're not a subscriber, you can get to those. Twitter, I kind of mentioned that last weekend. Yeah, let's see, Michael Harris mentioned IBD Live has a real good FAQ page too. And then I added in as a new resource this month. These are hard to find. They only made them 2 years. There's a 2004 one and a 2005 one. This is the one I found a picture of, and I didn't have time to take a picture of mine today. But these are old desk diaries. Sometimes I'll take a picture out of them and put them on Twitter, where each day O'Neill gives you a chart or a Can Sllim investing principle. So it's kind of like a thought of the day or a chart of the day as you went through them. So sometimes you can find them at used bookstores. Sometimes they're outrageous, like on eBay and places they're $70, $80. You know, if you can find them for 30 or less, maybe that's a good deal. I think they were 16 when they printed them, so that's not too bad. So I throw those out there, but they're just hard to find. But if you ever see them, grab them. You can get on a waiting list at the used bookstore sites and stuff for them. And so that's the title of them. So I just put one in there, and the other one's 2004. I like the 2004 one a little better, but they're both good. All right, let's look at the M factor, which everybody is interested in currently. So I always use the BMW advertisement. This is the most powerful letter in Can Sllim. And so we just want to remember, we don't want to argue with the market. We just want to interpret 50% of the battles being right on the M. And when we don't know what the M is, we kind of have to step back, play more defense than offense. So we look at 3 things: the action of the leaders, actions of the stocks we own, which is down to 2 in the group teaching portfolio, market pulse, distribution day count. Again, I do a weekend video almost every weekend where I update that. So if you follow me on Twitter, or I send it out by the Greenville Eastside meetup site also. So at our last meeting a month ago, we had 1 distribution day on the NASDAQ. We had none on the S&P 5. We had 11 buying days and only 5 selling days in the indexes, the way I count them, in the last 25 days, 25-day window at that point. And currently, so last week, as I mentioned in the pre-meeting discussion, IBD, we started the week green, then it went to yellow, then it came, under pressure, then it came back to confirmed uptrend. Last week also, the Steve Sweat's window of opportunity closed. We'll look at that in the coloring book in a minute. The NASDAQ MMTS flipped to red last week, and I think this week the Russell flipped to red. And then that buying selling day count has flipped. Now only has 6 buying days and 10 selling days as of yesterday's close in the 25-day window. Distribution day count, as we looked at earlier, has now jumped to 5 on the NASDAQ, 6 on the S&P 500, and 5 on the Dow. IBD is not counting them on the Dow, but they used it for the follow-through day at one point in the last year, so I started counting those again. They used to count them in the old days. So let's flip over to Market Smith real quick. Let's take a look at the indexes. So these are the daily charts. So I drew the red line on here. Here's 10% off the peak. I mean, it's amazing. We hit an all-time high just, what, 7 or 8 days ago on the NASDAQ. And now we've come down and crashed the 21-day, crashed the 50-day. Everything's turned down. The 50-day moving average line's flatlining. It looks like a line I drew on there, but that's the 50-day up there. So I just wanted to see where 10% off is, since that's defined as a correction. Now today we did have a big upside reversal day after a nasty plunge early. Still finished down for the day and didn't really have great volume, even in bouncing back. So you can see, here's the green, here's where they flip to red. So I got to change that. I think I put the MMTS on there. Sorry, I meant to put what IBD called it. So I'll fix that. So that's what we see there on the S&P 500. So today we lost the 21-day, tried to get back above it. So that'll be important to watch. The New York looking fine, holding the 21-day. I mean, this is the divergence we're seeing. Dow holding the 21-day, 10s above the 21-day, everything stacked in the right order. Russell is, again, had an ugly day too, like the NASDAQ, but did bounce back to at least a high range close, but was still down for the day. And then the S&P 600, we have to use SLY because I don't think this will update till overnight. I think that's yesterday's bar. Yep, that's yesterday's bar. So that one only updates overnight on the S&P 6, but you can use SLY, which is the ETF for it. Yeah, so it's lost the 50 days. So we kind of have this tug of war. You've got the home of our normal growth stocks, the NASDAQ and the Russell and the S&P 600 are all looking bad. You have the Dow, the NYSE, and the S&P 500, looking a lot better. So you have this divergence, and the bottom line is normally that divergence is going to get resolved one way or another. I mean, the growth stock indexes are going to pull the other ones down, or the opposite's going to happen. The Dow and the NYSE are going to pull the growth stock indexes up. And we just don't know right now. I don't know which way that's going to go. We're done with earnings season, so we'll have to see what the catalyst is. There's a lot of inflation headlines, interest rate headlines, pipeline hacks, stuff we don't see coming, out of right field. So we'll just have to pay attention. And if we look at my Excel spreadsheet, so yeah, I had the colors wrong on my NASDAQ chart. So here's where the NASDAQ flipped to red on the MMTS, which means the 21-day had to turn down, the 10-day had to turn down, and it had to go 1% under the 21-day. So it takes, a little bit of work for these to flip colors. That's why I use that. I wanted something that doesn't flip too fast, that flips early enough that you're aware of what could be coming. So it flipped to red the same day that Steve Sweat's window of opportunity closed. So this last column is his window of opportunity, which is only green or red, and is a market timing model. Just like the coloring book is something I look at to help me determine market direction, the window of opportunity is the extensive study that Steve's done. I've seen his presentation. And since he tracks it and updates his spreadsheet each day, and we all have a link to it, I don't have to track it myself, but it's just, I just look at all this on market direction. And his system incorporates the NASDAQ MMTS as one of the signals he looks at, but he doesn't look at the MTS like on these other 5 indexes like I do. And then here's the IBD column. The M is the market school exposure. Again, I just put that on there because I have access to it. It never goes higher than level 7. Power trend was owned, and see, it went under pressure. Power trend went under pressure Monday night. So last night, when the day the markets really got slammed yesterday. So that's where we are. And then I haven't filled in today yet, but I did fill in. We had distribution on the S&P 500, distribution on the Dow. So these distribution days are still sort of scattered. The active ones will always have a border around them. So there's the 6. I haven't put a border around today's yet. And then you can see where the ones on the NASDAQ are. So they're not clustered. Here's the 25-day window. There's not any dropping off anytime either, unless they drop off under the gain rule. And there's just a lot, you can see the red days here, a lot more red than green days in the most recent past. And that's just my call on, was it a buying day or a selling day in the indexes, depending on how they acted and what the volume was. And some days I just don't color them either way because there wasn't strong enough to tell. Today, as bad as the Dow was with distribution, I'll probably color that red tomorrow. So that'll flip this count to, let's see, we don't drop a day. It'll go to 6 and 11, 6 buying days and 11 selling days. Wow. So that's mounting. So let me go back to the presentation. So we looked at that. Divergence, okay, I talked about that. We can look at the group teaching portfolio. Oops, let me go to the dashboard page. So we're only, we got knocked out with earnings season and stuff on some positions. So we're only 21% invested. Some of our gains for this year have gone away. We're only at 4.48%, and we only have 2 stocks in there right now. So have a full position on tech, and then this one got extended before it was a full position. So ATKR, we'll look at the chart in a little bit. So that's sort of where we are in studying this. And then one thing I look at too, so I have the spreadsheet. So the sold page has all the positions that were sold. And then it also tracks in these 2 columns what happened after every stock was sold. So I use that for post analysis, and these just update automatically. But it's interesting. So if you add up the total of everything since they were sold, are down 91,000. So there's the profits year to date on the positions that were sold. And then here's the total since sold. And so that's interesting because early in the year, I'd kind of glance at this, and this was up. This was an up number. So the stocks I'd sold were profitable. So I go back and study, which ones were, did I sell something too soon? And then starting in early March, it just plunged. I mean, it was off. This number was down 166, almost 167,000 from where those stocks were sold on March 8th. So the market was really getting hammered there. Then it tried to bounce back. And then recently, yesterday it went over being down 100,000. So it's just kind of a secondary thing to track and to realize, yeah, it was good to lock in some gains. And then this just shows me there's additional weakness when there's big fluctuations in this number, and all of a sudden it was almost as big as the gain, and then all of a sudden it plunges to negative 167 in early March. So looking back, that was kind of like sort of a warning sign. And even back then I made a note, NASDAQ's hit, the Dow's up. Well, that pattern continued for sure. So that's what I was going to look at. Let me see if I had any questions on market direction that Michael has not handled. Yep, he's telling you how to get that. Yeah, IBD does have a good FAQ page. Yep. Oh yeah, if you're going to use the group teaching portfolio, you have to keep it in Google for all my formulas to work. I used to use Excel. I think Excel is a little more powerful, and I do use it for the coloring book, but the data feeds just kept changing and they weren't consistent. And Google Finance has more data feeds. Like I can pull in, volume, dollar volume average. So I can pull in more numbers from Google Finance than I could in Excel. Now, maybe somebody else knows how to pull more in Excel than me, but that's why I set it up in Google Sheets. It's also very handy with Google Sheets is I can work on it at the office, I can work on it at home, and wherever I open it on whatever computer, it's always exactly where I left it. And so that's a little more, I think Office 360 will sort of do that also, but the Google Sheets one works very well. So that's why I used it instead of Excel. And if you want to use that, I've done an hour-long teaching video on how to use the group teaching portfolio, and it's linked on the Greenville Eastside site. It's free. because it's a teaching tool and I wanted to put it out there. So you can get that and learn how to use it. It shows you how to set it up, how to enter the data, because most all your data is entered on the details own page, and then these bottom columns pull forward to page 1 to just give you the total. So you know at any point how much you own, how much you're up or down on that position. But then if you're going to trade around a core position, you go to this page and you see each lot you bought, when you bought it, if you want to sell it versus purchase. The market gets weak, you want to get rid of any losses, you might sell off that lot. So you need to know when you bought it and what you paid for it, so you can enter the versus purchase stuff in your broker platform. So it lets you track that, gives you the details here, and then it's all just summarized on page 1, and then it just tracks daily. Some people shouldn't track this daily because they'll look at it too much, but I set it up where if you want it to, you can track it daily. You just have to go in here each day and lock that number and then put that minus that, and it'll update the number each day. So that's that. Make sure I have another question. Yep, okay, Michael gave you the links for that, so you're in good shape over there. All right, let's go back to the presentation. And go back to big screen. All right, just a reminder on where we are in EPS season. We're finally at the end. We've been going since January 1st. So the first 5.5 months of every year is really earnings season, because the calendar year reports that ended December 31st, there's a 90-day, but for most of them, there's a 90-day filing window. So we get the annual earnings reports for 3 full months, January, February, and March. And then as soon as the March quarter ends, which is quarter 1, we have a 45-day window, which is April 1st to May 15th, which we're coming up on, for the first quarter reports to be filed. So that's why we've been in such a heavy earnings season, and this has not really been a good earnings season for buyable gap ups. There's a lot of things that are not working, and there's a lot of gap downs, but it's just good to know. But that'll end for the calendar year companies. There's always some companies reporting, because there's a good number that are not calendar year fiscally. So they'll trickle in, but we won't have a heavy season until starting July 1st, and it really takes about 8 days to get going. So July 8th, July 10th, we'll have a heavy 5 weeks of earnings season again. So you got to know your dates. I only trust one source, the press release from the company, which I just get off their website. You got to know your rules. Are you going to buy gap ups on earnings or not? You got to know what cushion do you need to hold through earnings. We had 2 group teaching portfolio, had to sell both of these pre-EPS last week, and then we got back in tech and should have gotten back in that one. It's actually done a little better than tech. So we bought it back, and that's okay. You're trying to avoid that 15% to the downside surprise. You want a cushion in order to go through that, and so you can buy them back if they report well, and they don't have to take off if they're just solid and you liked them. You put them in the portfolio, you've done your due diligence, then you just put them back in, and it's no big deal. So I covered buyable gap up rules in detail, and the setups I liked back in November 2020. Sometimes you get pre-announcements. Those are rare. Is there less a risk of a gap down if they pre-announce? I don't know. Dexcom in its last quarter, they pre-announced, looked like good numbers, and they still went down when they got to the earnings report. And then occasionally you'll get blindsided. Somebody's will hack the press release and it'll get out there early. Happened to Intel last quarter. Nothing you can do about that. It happens. I just mentioned that it can happen. All right, the I in Can Sllim. Let's talk about this and go through this in detail, show you how to research it, why it's important. And it's sort of like, hey, honey, how much gas is in the tank? I kind of wrote that I picked that title before we had the pipeline hack, actually. So some more important question than I thought. All right, so Can Sllim, Bill's acronym, of course, is the Super 7. And what he was doing, of course, I don't know that he knew it was going to be 7, but when he was doing his research, He wanted to look at the true market leaders going back to the late 1800s and try to figure out, hey, what did these great stocks have in common? What are the tell? What am I looking for in doing my research? How can I pick these up early going forward? So it ended up basically there were 7 things, really 6 on the stock, and the M, of course, is market direction. So bottom line is every letter is really important to us. And so while no stock is perfect on the Super 7, the more flaws that we accept in putting something on our watch list, the greater the risk it won't work. And I think I think the C and A, of course, are very important. N's very important. S, supply demand, that one may not be as key, but the L, the I, and the M, these are all very important. So the I is for institutional sponsorship. And Bill's belief and his research results were that it takes big demand to push up prices, and that's the institutional investors, mutual funds, pension funds, hedge funds, insurance companies, large investment counselors, the bank trust departments. You have state and educational institutions. I mean, they have endowments that they invest. So these are the big money. And that's what accounts for really the lion's share of what we see on each day's chart. When we look at the chart, it's not us that's showing up on the chart. 70 to 80% of it is, I'm gonna call it institutional money, but it covers all big money. It covers all these categories that Bill laid out for us. And it can be big lots on the tape. I mean, we don't normally see that unless, we're looking at level 2 trades or something. I don't normally look at level 2 to try to track that. But yeah, Bill said it can be up to 70% of the activity of the leading companies. And so that's what's driving the price moves. So stocks just can't go up with that. We're not going to push it up. We're the fly on the elephant's butt. We don't matter. We're one-click traders. Or as Bill would say, that's not it, Aunt Betty down the street creating that volume footprint on the chart. And Amy Smith will, she's the volume queen. She'll hone in on that too. If you ever hear her speak, she's like, look at that volume. Look how many dollars that is, on a breakout or something, on a big stock. Look how it compares. Look left. You don't see any super big bar like that, like on the Facebook breakout when it finally broke out after went sideways for a year after the IPO. And being a one-click trader, I say that casually, that's an advantage we have that the big boys don't have. They can't get out in one click of these massive positions. They have to accumulate them over time. They have to sell them over time. I often say it is they have to buy when they can and they have to sell when they can. And we're not like that. We can do that at any time, and that you click, it's gone. We didn't move the market. As long as we're buying liquid stocks, which I'm going to talk about, not some thin junk, we're not going to move the market. It's just not going to matter. And the other advantage we have is we can go to cash. I mean, you saw the group teaching portfolio is 80% cash, just because of uncertainty on market direction, and so many things have not worked. So that's just where it is right now. We want to wait for the right pitch. We want to be Ted Williams batting, and he knew what his sweet spot was, and it's kind of hard for Can Sllim growth investors to see that pitch right now, I think. So the big boy, they're not one-click traders like we are, so I kind of have that in there. That's a duplicate. Also, they can't buy breakouts like us. I mean, that's too obvious. It's going to move the market too much. They have to buy when they can. They have to sell what they can when they can, and they're the ones building the patterns. They're doing the work that we want to take advantage of. They're also looking to park money longer term. O'Neill has an institutional side of the company that they cater to and give advice and sell advice and reports to. And, he said, or Scott O'Neill said in one of the old webinars, we had money managers tell us, hey, we want this to be a 5-year investment. It sounds like Kathy Wood. We want to park this money there and have it grow. It doesn't have to grow exponentially, but they want it to grow, and they're looking for a place to do that. So that's totally different than us. They can't hide their accumulation from the chart. It's going to show up in price and volume, even with dark pools, even with algos, even with all that stuff. It's going to be on the chart eventually, and we're going to be able to see it. They also have to disclose what they own and how much of it. It's delayed. I think theoretically, let's say their reporting period starts October 1st, last 3 quarters of the year. So they could buy something at the beginning of October and keep buying it and keep buying it. The reporting period closes December 31st. So whatever they bought in that 3 months is going to have to be disclosed, but they don't have to disclose it, 45 days, February 15th. So they're able to accumulate it without showing all the buddies in the filed reports what they're doing. But still, it has to be reported, and you can see those changes. We're kind of just looking to make sure more and more funds are buying it. And then if we see somebody like Fidelity Contrafund or somebody increasing their position size, then that's a nice thing. It also takes them time to buy. When we're a one-click trader, we can be done in 1 day if it hit all our entry points and if our rules allow us to do that. But just assume you've got a 5 billion fund. That's not a massive fund. Fidelity Contrafund is 125 billion. Now it's massive, but decent sized fund, and they want 2%. They want 50 positions, 2% in each one. So that means they got to buy $100 million of stock. So if you take a $50 stock that's trading 1 million shares a day, so that's $50 million a day, that's a liquid stock, that's a fund quality stock. And they just want to buy 5% of the shares that trade each day. Because if they buy too much, they're going to push the price up. So they need to buy 50,000 shares a day. And so if we have 22 trading days a month, it'll take them 2 months to build that position if they buy every single day. And it's not likely that they're buying every single day. So it's more like 2.5 to 3 months for them to even build that 2% position in one stock, 2% of their portfolio. So that's the institutional accumulation. These several funds doing the same thing day after day, week after week. That's how, when you see a chart and you go, wow, that thing's been up 8 weeks in a row. It's got good volume bars in there. That's the institutional accumulation that we're looking for. And it's because of that process. It's because they can't buy it all at once without moving the market too much. So they have to do it gradually. They don't want to show their hand to all their buddies. So they have to take their time. So this is what we're looking for. Those footprints in the sand, the big ones. And that's the price and volume on the chart. And so that's what's helpful to us. And also, that last example of how long it takes to do it, it makes me look really smart. But if Lee Tanner was here, he'll tell you what page everything is on in which book, and he'll tell you to go to the Successful Investor page 22, and that's where Bill laid out that example. So I'm just confessing I didn't make that up. I got it from Bill. And again, mentioning the book. So the Successful Investor is the one that Bill wrote after the 2000 to 2003 bear market, just laying out the Can Sllim system again, because so many people got hurt so bad, didn't have sell rules. He kind of went through the highlights. It's sort of like, what part of my system did you not understand book? But it's worth rereading, and I was rereading it before I did a prior fund institutional discussion or teaching segment, and that's when I saw that he had it in that book, how the funds actually get in. So he was giving us more details on that than are in How to Make Money in Stocks. So it's worth noting that. And then when I'm dealing with the I in Can Sllim, I really think we have to add in a new L here too. I'm going to go SLLIM. And that L, the second invisible L that goes with the I, is liquidity. Because the funds cannot buy illiquid stocks. They can't get enough to make a difference in their portfolio without moving the market too much. So if it's not liquid, we're going to talk about what that means, then the big money is not going to be able to trade it. They've got to be able to get in and hopefully get out without moving the price too much. And so that's why they don't really care if a stock is higher priced, because it doesn't matter to them. They're kind of like us. We're trying to put in X number of dollars or trying to allocate X percentage. And so it doesn't matter if your standard position size is $10,000 and you hope to make 20%. Well, 20% on 10,000 is 20%. It's $20,000, whether you have one share of some Berkshire Hathaway stock or you have a bunch of shares of a stock that's not that large, or as large as that. So we really don't care. Some people, oh, $500, that stock's too expensive. Well, no, if your position size is the same, it's the same price as everything else. You're allocating the same number of dollars to it. And if it goes up 20%, 20% is always 20%. So you're hoping to make $2,000 on it if your standard position size is $10,000. And it takes a while to realize that. Most people, when somebody says a stock's expensive, it's kind of like, well, no, it's not. It's, it's the same position size. It doesn't matter. It's $10,000 worth. No matter how many shares it is, it's the same dollars worth. And then the funds have to buy enough to matter. They need to get that 2% or 2.5%, whatever their allocation is. I mean, the funds are not concentrated like Bill O'Neill was. The hedge fund managers may be, but the mutual fund managers are not. So how much liquidity is enough? So IBD and Bill originally taught it in terms of shares traded, saying, hey, you need 400 or 500,000 shares per day. Sometimes they'll say a little bit lower, sometimes they'll say a little bit higher. I think this is the wrong approach, and I abandoned this approach of counting the shares a long time ago, because I think we ought to go with average daily dollar volume, because then it's always apples to apples. Regardless of how many shares it trades, if it trades $50 million per day, it trades $50 million per day. If it trades $200 million per day, regardless of the number of shares, then it trades $200 million per day, and it's a very liquid stock. So I think they ought to switch that, because again, 400,000 shares on a $400 stock is 4 times as liquid. I mean, that's a big difference. It's 400,000 shares on a $100 stock. So why does IBD treat these the same when they're not? And they're getting away from it some. In fact, I knew some people that have been to the master's classes, and they told me that most of the time in the master's classes, they talked about average daily dollar volume. And now on IBD Live, they'll look at average daily dollar volume. Some of the articles in the paper will talk about average daily dollar volume, but they haven't officially switched. They haven't abandoned the number of shares traded per day. But to me, that's a red herring. I just want to know the dollar volume. And I have my MarketSmith chart set up where it automatically shows me that. I'll show you that later on every stock I'm looking at. It's built into MarketSmith. I got average daily dollar volume. I don't have to do anything. I don't have to do any math. It's right there in front of me on every stock. And I'm always comparing apples to apples, because to me, there is a difference between a stock that trades $40 million per day and one that trades $250 million per day. So how much is enough? So you're using average daily dollar volume. What's your guideline, Greg? Well, you got to decide that works for you. But here's some thoughts. First, the general rule is the lower the liquidity, the higher the volatility. Just as a general rule, I mean, I've seen that play out in the charts over and over. So that's my general rule. Lower liquidity is higher volatility. So I always want to keep that in mind, because I don't want everything to be on the low end of my liquidity, or I'm going to have volatility in everything. And also, if the liquidity is really low, maybe I take less than a full position to control the risk, because that's another way to, while we want our position sizes to be the same, if we're going under our normal rules, then we'll vary that to control the risk, and maybe just do a 50% size position, or maybe do that on an IPO because they're more volatile by definition. So you just got to decide that. What's your general rule per stock and portfolio construction? That's just what I covered. You don't want to have everything right at the minimum that you decide is okay. So here's some guidelines. So Kathy in the life cycle trade says on IPOs, you need at least $20 million per day. So she's using dollars per day, just like I advocate, or they're too thin. So that's a guideline. I think she sort of uses that for her Canslim stocks too, not just for the IPOs, but that's what she put out there. Leaderboard has to have 25 million in average daily dollar volume for them to put a stock on leaderboard, because when they start getting thin, they're moving the stock. When they're sending the alerts out to so many people, that it's driving the price up if they go any lower on this liquidity. So that's what they use. So that's a possibility to consider. Lee Tanner has taught that he likes to see $40 million per day. He will trade thinner. He'll go under that, but kind of likes to see that. I was talking to somebody else recently, very experienced trader. He liked to see 80 to 85 million. That's what worked for him. Portfolio managers I've heard speak, 100 million, 150 million. They're going to be higher, 200 million, 250. They're not us. So don't use that. I don't recommend that as an individual, as a guideline. I just throw it out there to tell you how they think about it, and they're using the same thing on average daily dollar volume. Me, I kind of like that 40 million number that Lee uses, but I'll look at stocks, down as low as 10 million, but I'm not going to have a portfolio full of those, and they may not be a full position size. If something down there. So, you get 40 million. I mean, I think that's an institutional quality stock. And we're looking at fund ownership. So, I mean, when I'm looking at $40 million stocks, I'm seeing some good funds in it. So it sort of lines up. So there's just some guidelines for you. You've got to decide what your rule is. But I think I've given you enough of the spectrum that you can sort of pick and have somewhere, what your starting position is going to be. And so the guy that said he wanted 80 to 85 million is sort of the thought, hey, higher liquidity, lower volatility. And so that's sort of, he likes to be in that range, and that's what his post analysis has showed. So that's what he uses. But that's a good enough. But I would always use dollar volume rather than shares. Keeps you from having to do the math too. So how do we track this? All right, like I said, I set it up as one of my columns in MarketSmith, so I always have it in front of me. We can get out. Let's go back to MarketSmith for just a minute, and I'll just show it to you. So I just pull up. This is our list from the April meeting and the May meeting, but it's right here. So my preset columns at the bottom, my standard setup, is right there. It's an important column to me. These are sort of in order of importance. So I want to see return on equity, even though it's up on the chart. You have to go to the weekly chart to, oh, well, that's the index chart. Hold on, I got to pull up a stock. So it's right here. It's on the chart, 88%, 88%. But I like to see it beside pre-tax margin and debt. So I put it down here also. And it's only on the weekly chart. So if I have a daily chart up, I can't see it. So those are important to me. But right after that, I have average daily dollar volume. So I want to see this. That one's $17 million per day. This one is $1.3 billion per day. So that's liquid enough. But you sort of can see the range of these stocks. And so I just put it in there. If you don't know how to set up these columns, call your MarketSmith coach. That's something you have. And you can make a snip of mine, if you want to use these. I have EPS due date down here. Even though I don't rely on their dates, this tells me to start looking, for the press release when I'm getting close to that. And I put this number you saw in the group teaching portfolio, because I spent like 2 years building this spreadsheet, getting everything in it that I wanted. I mean, tweaking it, not 2 years to put it together. But I have the earnings column in there. So I make sure I don't miss the earnings date on anything I'm looking at. So these are just estimates now. When they're confirmed, I'll change it and say put PR per the press release, meaning I've read the press release and I know it's a good date. But right now, these are both, unless I made a mistake, I'll have to double check it because they're both the same, but they're set for July 28th, estimated. So I put that in there. So I have that down here so I don't forget about it when I'm doing my weekend screening. And then I have some estimates, industry group, what industry group they were in 3 months ago, in 6 months. Oh, those columns should be next to each other. Sales growth, I think that's over 3 years. And then some other things that aren't quite as important, but I still have in my standard setup. So you can set those up, but I like that. So I'm always looking at the same picture on every stock, and there's my average daily dollar volume. So I don't have to look at, 50-day average share volume and do the math to figure out what it is. I can just look down here and I got it. So let me go back to the presentation. All right, so how do we track it? Set it up as one of the columns, and then just a warning that that Market Smith number at the bottom of the page, it is wrong on IPOs because it's a 50-day moving average and you don't have 50 days of volume, the number is skewed way up. So until that 50-day moving average line shows up on the chart for 3 or 4 days, because I need to knock out the first 3 or 4 days of trading on an IPO because it's so high, it just skews everything up. So until that 50-day moving average line shows up, don't use that dollar volume on IPOs. I mean, I have a spreadsheet where I download the data from Yahoo and I get the actual shares traded, and I just do it on closing price and middle of the day price. They work out about the same. Median price, they work out the same. So I know what the actual dollar volume is, because I've looked at IPOs where like the 10-day average may be well down under 10 million, and Market Smith will have it at 30 million per day because it's early in the process and it has those 3 or 4 IPO days in there with only a couple weeks. So that's a big red flag. And there's really no way to, I don't know what they would have to do to fix it. They'd have to reprogram it, but I just know I do not rely on that if that 50-day moving average line has not been on the chart for 3 or 4 days. So, and I'll show you that when we do some IPOs. And then once it's there plus 4 days, or it's been there for 4 days, it's got rid of those high volume IPO days, and I think you can rely on it at that point. So I just call it the 50-day plus 3 or 50-day plus 4 rule on checking volumes. So how do we track the funds? How do we get to the ones that matter that we want to pay attention to? And so, first of all, not all funds are created equal. You know what? It's almost 8. Let's pause there. Take a 5-minute break. I'm going to stop the recording.
This conference will now be recorded.
Right, Michael's got all the questions covered. You got Steve in there to help you, so thank you very much to him. And go back to the presentation. All right, so let's talk about looking at the actual funds that matter. Do they count? So not all funds are created equal. So Bill, back in the day, had a hand-picked list of funds that he thought were important. So either he knew the fund managers personally, or he knew the fund manager's style. Again, remember, they were selling data to these guys. They had an institutional arm of the company. That's mainly what they did. The fact O'Neill gave Can Sllim to the retail investor, all of us, was really a very nice gift. And he did not have to do that, but he wanted to teach people and he wanted to help people. But he was rubbing elbows with Will Danoff at Fidelity. If you saw that, when he got some investing award, like they interviewed a young Will Danoff talking about Bill O'Neill. So those were his customers. So he was connected with them and he knew something about them. And so Market Smith makes it so easy now for us to track the important funds with 3 features. So the first one is ticker 0MUTI. So that only works in Market Smith. You have to be a subscriber. And it's a 0, it's not the letter O. So this is the current list. There's 20 in there, if I remember correctly, of the hand-picked funds at IBD. It doesn't change very often. Maybe once or twice a year, they'll take one out. They'll put a different one in. But it's not like you have to keep an eye on it every week, and it's automated anyway, as I'm going to show you in a minute. So here's the list. It's actually in the paper every day. And on the weekend, it's on that general markets page. So here's the 20 funds, got Fidelity Contra Fund in there, of course, has their performance since January 1st. If you want to glance at that, let's look at those. So Contra Fund's up 7%, Janus is up 8%, T. Rowe Price, actually down 1%. Okay, Wells Fargo's down, Wasatch is up. So this is in the paper, so you can see them, you know what they are, and I guess you could track that to figure out if they changed anything. So are there key funds or ones to focus on within this 20? I'll say yes. I think there's 3 that are very important. I got this from IBD Live and really from old webinars also, but they have focused on it on IBD Live. So one of them's Fidelity Contra Fund. Will Danhoff runs that. That is the largest single manager fund that's out there. You can have a large fund with multiple managers, but that's a single manager fund. And I think it was, last time I saw it, 125 billion or 130 billion assets under management. So I think Kathy Wood's up to 50 billion for comparison purposes. Then the second one, T. Rowe Price New Horizons, is one they focus on a lot. And the third one is the Lord Abbott Fund that's in 0 MUTI. I'd have to go back a screen to see the exact name of it. But the guy in charge of that has been on some of the podcasts and stuff, and he's clearly a Canslim oriented fund manager. So those are the key ones within 0 MUTI. And I just say these are sort of the best of the best for with what, you know, what we're doing with regard to the I in Can Sllim. And then the second tool, the really time-saving tool that is awesomely cool. And MarketSmith, you know, they roll out a new feature or so each year, and some of them are really nice. So the side window panel in MarketSmith, over on the right, it automatically shows us which of those 20 funds are in any stock chart that we've pulled up. Or if it's none, it doesn't show any of them. But it's automatic now. It didn't used to be automatic. They rolled that out, I guess, between a year and 2 years ago. But you should never do your weekend work or any work without having that right-hand panel open, so you always see that. Used to, you had to manually flag the ones that were in 0 MUTI, then you had to open the bottom panel, and then you had to sort them to bring the flagged ones up to the top. So it was several steps, and you would just forget to do it on every stock is what would happen. But now it's automatic. So it looks like this. It's this panel. You click on those little arrows and it opens up, and then it is the owners and funds tab, and I just leave this open. So it gives you the history of the funds. You can see if they're growing in number, but right here, it'll give you the list of the ones that are in 0 MUTI. So there's only one in this one. It has 1.41% of the fund in this stock, but you know, at least you have one. And then if you click on show fund ownership, it's going to open the bottom tab where you can see which ones you've flagged above and beyond these 20. Don't ever flag the 20 because they're going to show up automatically. You just flag the ones beyond the 20, and that way you can look at this and go, okay, there's one of those, and then there's 3 of mine. And I think I have an example in here. I don't know. So here's no, this is just another stock showing you that panel. So this has very strong fund ownership. I mean, you've got 7 in there. That's a lot. And you got Fidelity Contra Fund, which is at 0.01%. So it looks like they're starting a position. You can see this one trades 85 million per day. Both these are the 2 that are left in the group teaching portfolio, by the way. So there's your 3 green dots. You've got triple digit earnings and Can Sllim sales in the last quarter. So they're lined up over that last quarter. And then this one, this wasn't up to 40%. So it didn't have any green dots, but good RS line and everything, but good fund ownership. And then the third tool is to flag your own funds. And so you can do that. You just click on that little flag and it turns orange. As I said, don't flag those that are in 0 MUTI because those are coming up automatically. And then your funds will show in the lower panel. So if you don't have any of the IBD, you can still check, it's okay, if some funds that you have flagged are in the stock. So here it is, I've opened, so I clicked on show fund ownership because it shows hide fund ownership. So on this stock, there's one of the IBD ones, and then there's one that I've flagged. So you just sort by the flag and it'll pull them up to the top. And if I open that panel, it would tell me the name. I don't remember the name of that one. That went off the bat. So that's how you check that. So in my MarketSmith notes, I would put this one has 1 MS TRF top rated fund and 1 of mine top rated funds. So it's got some institutional sponsorship. And then this one, same stock that we looked at a minute ago, here's strong there. And then it has 4 that I have flagged beyond all those that are in ticker 0 MUTI. So in my book, the stock has very good fund sponsorship. The IN strong and Can Sllim on this one's strong. And then you can look down here and see that it's been growing 600, 671, 692, 709. It's not knocking it out of the park, but it's gradually growing. So how do you know when to flag a fund? How do you come up with that list? Well, I use the paper. There's an article in there on a fund and a fund manager every month. And if I read it, and he owns a bunch of Can Sllim stocks that they're highlighting. I mean, they'll highlight 5 or 6 stocks that he owns. And if I go, yep, those are all strong growth stocks. And you read what he's looking for and what they're focused on. And most of the fund managers they're interviewing are going to be more growth oriented. But if he looks like a strong one, I just flag the fund. I think Steve has told me he flags all the ones they write an article on, and that's fine too. You can do that. I just do it sort of the way I explained it. So you get the detail, his investing philosophy. Sometimes there's fund managers, there's 2 of them in the article, it doesn't matter. But then, we'll just add it. And then on IBD Live, they'll mention some funds, the various hosts that they really like. So that's another source. You could fund one, just pull up that fund in MarketSmith, put a note in the journal, said, hey, Scott St. Clair really likes this fund. It's something he likes to see, and just flag it. And that way you'll know it'll show up in your list at the bottom. You just don't want to have like 100 flagged, you want to overdo it. You want to be a little bit selective. So what happens if you have 0 funds in the right-hand panel and you have 0 in the lower panel? I don't have any that I picked. What do? Well, you can sort the ones that are in the lower panel, even though you haven't flagged any, by the grade that IBD gives them, because they've graded them, and just count how many A+ A and A- funds are in there. And that just gives you a benchmark. If you've got a good number, 20 of each or something, 15 of each, then, at least some highly rated funds are in it. So you know how to check it. So you've got 20 or so funds in 0 MUTI. Let's assume they have 100 positions per fund or 50 per fund. And the fund managers have looked at all the profitable liquid companies out there. That is their job, to screen, to find the next Apple, to find the next Microsoft, to find the next Cisco. They've looked at it. So the big question for Bill was, so why has not even one top manager put this stock in this fund? And so that's what he would focus on. And so that was really important to him. One other way we know it was really important to him is his portfolio managers who were handling his money could only trade off an approved list. So that kept them from going off the reservation. Now, it's an extensive list. It has many stocks on it, but they are limited to that list. But you could go and lobby Bill to add a stock to the approved list. Hey, I think this is great. Here's the reasons. You had to go in, it better have earnings and sales, better have strong growth. But there were 2 questions Bill would always ask when somebody was presenting that fund to him. What do they do? He wanted to know what the end was. You better be able to tell that story and why it was a good story. And number 2, who owns them already? So he wanted to see some fund manager who has the ability to kick the tires in a way that none of us do, in a way that Bill O'Neill did not have the ability to do, and had the experts to look at the financials, to do all that stuff. We're really just piggybacking off of them, if you want to know the truth. And so he wanted to know that. He wanted to know that some of these great fund managers out there, even though they could be wrong, they had put their money where their mouth was, and that they were good fund managers. So, and sometimes there's a reason there's not a top rated fund or any funds in it. It's an IPO, so you don't have any data yet. That's going to happen. It's not a growth industry. So all these stocks that have been leading lately, oil and gas, financials, staples, the value plays, they always, or almost always, have 0 of the MarketSmith funds and 0 of the funds I have flagged, because they're not growth plays. And that's what these funds are focused on. They are growth investing funds. So they're not going to be in there. So you have to overlook that. If all the money is rotating into oil and gas or financials, and you're going to rotate rather than go to cash, because you have the option to go to cash, you're going to rotate, then you have to realize, hey, this is just the nature of the beast. My funds aren't going to be there. The Chinese companies are normally going to have zero top sponsorship. And that's perhaps for good reason. They don't play by the right rules. So, you know, it happens. So you get the Lookout Coffee Shop fraud last year. You get NQ Mobile fraud many, many years ago. You just get that stuff. You get, if you want to go watch a good movie, go watch The China Hustle. I think you can rent it on Amazon, which is on the Chinese fraud companies put together by either the Citron guy or the Muddy Waters guy. I can't remember which one did it. I think it was Andrew Luck, whichever one he's with. So a good movie on that. So they're not going to have sponsorship, and that may be a reason you don't buy Chinese companies, and that's fine. I'm like that most of the time, although I did try KE Holdings last year, which was an IPO, and it worked fine. That was a Chinese real estate company. Hasn't done as well since then. It's one that Kathy Wood's in, but I'm out. So, you know, if there's no sponsorship, no flag fund, no zero MUTI funds, none of my funds, that's a pretty big red flag for me. So that concerns me. So here's a snip of the article in the paper. This is the one from last weekend. They always highlight 2 funds. You can see there's 40 total, and I think that includes the 20 in zero MUTI, because like I know Fidelity Contra Fund and some of those other ones will be highlighted in one of these 2, you know, once every couple months it shows up. So I think they rotate the 40 through here. So I haven't flagged the whole 40, but I've called MUTI catches 20 for me, and then I've probably flagged another 10 or 15 of those. And somebody's going to ask, which ones have I flagged? I'll make the list, and I'll either link it when I send you all the links to the recording, or I'll put it on the Greenville Eastside site so you can see it. You're free to copy my list. It's not anything special, but it's just the ones I have flagged over the years. And then you also get this article once a month. This is another place to just see what a fund is doing. Again, I highlighted the 2 that are left in the group teaching portfolio. They did actually both show up this month. So you had 8 funds buying $75 million of this. These are the fund. It's the top 30% of the funds over the last 36 months, and it's buys in the last 3 months, or the last reporting period, I guess is what they do. And then down here, Tech had 10 funds by $61 million worth. So, and again, that's a higher price stock, $427, doesn't matter. So you can go through this, see if your stocks are on there. If it's something I'm looking at or on my watch list, sometimes I'll just make a note in my little Market Smith journal, hey, 25 funds bought $795 million worth of this stock. So that's important, but this just comes out once a month, the first weekend after a full week of the month. So not necessarily the first weekend of the month, but the first weekend after a full week of trading. This will be in there, so worth reading. Other helpful sources. So one other thing I was going to point you to is Morningstar. So if I can pull it up, you have to register. I don't pay for this. Oops, let me get that down out of the way. So I have to go to just sign in. My password should be in there. And so you can get in here, and this just, and then you have to enter the quote way at the top. So let's just put in, I didn't put this in advance, so we'll see. Oops, or I was going to put Roblox in here. Okay, so it pulled it up. You have to click on it, and then you'll get the screen, and I'm going to ownership over here on the right is what I want to know. I mean, you can read about the company, but you already know this. By the time you get to this point, you already know what you're looking at. So if you go to ownership, this will be broken down into, once it pulls up. So major ownership, concentrated, buying and selling. You can click on each of these and it will pull up the list. I mean, there you've got a T row price in there. The new position just bought 3.9 million shares. So you can flip through that. You can see if any are selling. You can see who's concentrated. So this is a place to get a little more flavor. So you got a lot of the T row price funds in there. So we know that they have a top fund. So we're going to assume their other funds are okay too. And then you also can switch to institutions, which will bring up, you know, different maybe retirement plans, asset managers, that sort of thing that aren't mutual funds. So you can get a good, that's really the only other source I go to check fund ownership. And again, you have to register, put in your email, but I do not have a paid subscription. I can get everything I'm showing you without paying for that. So let's go back. We looked at that. Go back to the big screen. Yep, so all that's free. Okay, one final golden nugget. This is a gem, I think. So this came from Jim Ropel. I heard it in a podcast he did with Arusha. If you can find a strong growth stock, in other words, a good Canslim stock, where Fidelity Contra is just starting a position, that can be a golden nugget. So if Will Danoff, if this is new to him and he just has that 0.01% position or something, keep an eye on it. It may not pan out, but you know, it's valuable. And as Jim pointed out in that podcast, these Fidelity managers don't trade in a vacuum. They talk. They tell each other what looks like a good stock and what looks like a good idea. In the lunchroom, they probably talk about what Will's buying because they want to know. And I have found that what Jim said has been borne out. If I see Fidelity Contra Fund with a small position and I open that, or even a major position, and I open that bottom panel and I sort them alphabetically, I normally going to find a bunch of other Fidelity funds in there. So here's an example. Here's Fidelity. They have a 0.24% position, so they're building a little bit of a position. And then look down here. In my flagged funds, I pull up 4 more Fidelity funds. Imagine that. So again, what Jim had said, and if I didn't pull them up in my flag funds, you can sort them alphabetically by clicking on name. I mean, this is a snip, so I can't click on it. But if you click on name, it'll support, so it will list them alphabetically, and then you just scroll down to the F's and you can see how many Fidelity funds in there. Because if I did that, there's probably more Fidelity funds in there than just the 4 that I flagged. So that's a great way to check that. Oh, one final tidbit, just so you don't get hung up on this. Somebody in my meetup did one time and I had to explain it to them. So right here and right here, where it gives you the last reported quarter, the number of funds, like that's 3,191, which is the same over here. That last number is always changing until they show, until this flips to June, because funds are reporting that they've added or they're out. This will go up and down. So if you look at this, let's say this just showed 3,000 and it showed 3,000 the quarter before, you're going to go, oh no, something's wrong, because it had been growing, you know, by 200 per quarter and now it's flat. Don't rely on that last number until you can only rely on the next to last number. So the last one's always changing is what I'm saying. So don't look at that and say, oh, it's down in fund ownership, and only look at that last number, because it may be early in the reporting period, maybe early in that 3-month cycle. So just keep that in mind. I don't want anybody to get hung up on that, because I had one of my members one time was confused by that. I said, no, that's not a bad signal. You can't treat it that way. Okay, let me see what kind of questions I generated perhaps by that lengthy discussion. Custom column layouts. I do, okay, you have it saved, but you have to launch it. I won't show you how to set it up because it's a little bit of a process, but the Market Smith coaches can help you. But I have it. Okay, so let's say I pull up, let me go down to the Growth 250. So I'm starting my routine over the weekend. I pull up the Growth 250. So it doesn't have, it's not sorted by my columns. So I just have to go over here to this little wrench. So I do have to do this each time, and select column layout. And then the last one I did was September 2020. And so it will apply it. So when I'm looking at something like the Growth 250 or something, I have to do that. Now, if I'm looking at my weekly watch list, once I've done that once, it sticks with that list. Like, here's my watch list for this week. Yeah, see, it comes up with my columns. Once I do it once, it'll lock it in. It just doesn't lock it in on the Growth 250. So each weekend I have to do it in the Growth 250 and each of the Growth 250 sub lists. But once I have loaded a list in here and have done select my column layout, this will be here each time I open it. I do not have to do it every day when I open MarketSmith. So any list I've built, it'll apply automatically. So I hope that answers your question on how to do that. How often is that updated for every stock? I don't know what their data feed is on that one, Aaron. You know, it's kind of the trend over time. So the only time it can, you know, if it's an IPO, I know the data is not going to show up. I'll go to Morningstar. That's where I'll find the data quickest on an IPO. And things like Kathy Wood's buying will show up in that Morningstar site. Like if you go look at IPO Path, she'll show up. Her ARC funds is buying it. But I do not know. I don't know what their data source is. I would have to ask them. But the data lags anyway. I mean, if they don't file their reports, but every 3 months, you know, who has really current data anyway? Unless it's on the ARC funds, because she gives it to you every day. But you know, that's about it. Nobody else does that. Although I'm sorry, they have said on IBD Live that Fidelity they do their reports every 30 days. So there are some funds that will report quicker. I'm assuming once the reports are filed with the SEC that everybody's picking it up out of that database, but I can't answer that for sure. Okay, it is 8:30. Amazingly, I have only got through one segment of our agenda. So I apologize. I want to switch to some charts. So what I'll do is we'll take that ETF discussion. We'll go into that more detail next month. I will go through that. I will move it out of this slide deck and put it in a different slide deck because I do want to teach it. I don't want to send it out there. So I'm just going to scroll down past all of that and go to the next item on the agenda so we can look at some charts in this final 30 minutes and then get also to stocks you all ask about. So the group teaching portfolio, one, as I always emphasize, it's important to keep good records. You don't have to use my spreadsheet. I built it. I make it available to people. There are spreadsheets you can buy that will do that, but I just have, again, a lot built in here. I have average costs built in. So you want to make sure you're not running, you know, anything I may not look at this all the time. I have the total cost built in. If I look at this list, 60,000 is a standard position. If I have 7 stocks in here and only one of them's at a full position, and normally I highlight it in green, I hadn't done it. Full positions, I'll just shade green. So I know that, hey, I bought that properly and got to a full position. If I look at this, and that's been a flaw of mine in the past, if there's 7 stocks in the group teaching portfolio and only one of them's at a full position, it's like, okay, you're not buying right. Something's not right. You know, you may have one that got extended and got away from you, but you shouldn't have 6 that got extended and got away from you. So you got to look at that. And then it shows the daily percent of average daily volume, market value, you know, gain losses. It updates automatically. I mean, 20 minutes delay, whatever Google's delay is, but it all does it automatically. Earnings date, volume, average daily dollar volume, that sort of thing. Detailed own page. It has all the details. And again, the borders flow through to the first page. So once you enter your data here and link it on the first page, as you buy and sell positions, it'll change on the first page. So it's set up to do all that. And then again, the details sold page is very nice to go back and look at what happened. This is the sold column. And then, you know, look at the ones that are up, the column, the arrow zone, since we sold them to see, and I can go back. So like this one, so I mentioned this earlier. So this one had to be sold. Let's see, we got stopped out of one lot. That's a 7% lot. So that stopped out on the 29th. And I just highlighted it yellow because it was the first sale. When it was still on page 1, it was sold and wasn't in the totals anymore. So I just highlighted it. And then these both had to be sold the day before earnings because you didn't have enough cushion. I mean, you can see what they were sold at, and then you can see how much they've gone up since they were sold. So this is the one I said, hey, post analysis shows me should have got back that one quicker. It was still within the buy zone after earnings. So at least should have bought back that B1. And then it have position sizes over here. There's 50%, there's 20%. This one had an add-on buy, so it was add 10% size. So I noted that there. So this lets you track, and you put some notes in here, so you can go back and do your post analysis, and the whole purpose of this is to adjust your rules and to adjust how you trade, and not to make this mistake again, to say, hey, that was a decent stock, Can Sllim stock. We can pull it up here, Market Smith. You followed your rule. You had to sell it before earnings. You didn't have enough cushion, but you could have got back into it. Let's see where the earnings. Oh, it didn't pop up on the chart, but it was right here. Oh, there's the red arrow. It did pop up. So this was right before earnings, so it was sold on that blue bar because it didn't have a cushion. You can see the buys over here, and then the next day it didn't really gap up, but it went up, and so it could have been bought within the blue zone, the original buy zone, and easily could have got back at least the B1, as it performed well. And it reported, you look at the chart, good numbers, massive earnings percentage growth, finally went to Can Sllim sales percentage. So I hadn't put the green dots on here, I should. So that was a mistake. And the group teaching portfolio spreadsheet, if I didn't track what happened after I sold it, I'd just be thinking, oh, it went up, but now I'm like, well, no, this really went up. It's up 12%. You could have bought it within the blue zone. So you could have got back in that one. And then tech was another one that had to be sold. We did get back in it, and it'll be on the detailed owns page where we got back in. So, we've made a little bit of progress, not much, but we got back in right after earnings and got back to full position size. And because I liked what this company did. They're not a tech company. They're a biotechnine company, and they are really a picks and shovels. They sell all the diagnostic testing materials, formulas, fluids, whatever, to worldwide, to pharmacy companies, drug companies, vaccine companies, whatever. So they're not a fantastic grower, but they've got fantastic, fund ownership, and they have run up since the COVID bottom, 160 to 400. So they haven't quadrupled or anything already. I'm trying to watch that. Some of these that have, quadrupled off that COVID bottom, they're struggling to make much further progress. So we keep an eye on that. And then the other one I was going to mention in there, so this one wasn't handled well, another mistake. So BNTX, go to the daily chart, see if I have it marked on here. So this one had a sloping trend line entry. I think I took the early entry and then sold it. The group teaching, these actually were supposed to be blue. I think it changed the arrows. These were the sells. So I sold it really above the 20% profit goal. I think the market was kind of weakening there, and I should not have sold at all. I mean, this stock, this is one of the few stocks in doing post analysis that as it came up the final right side of this chart, look at the blue volume bars. Hardly any stocks in this time period had those. Yeah, they're one of the vaccine, right? But the fact is, this volume clue, there's so many stocks now that have built the right side of the base with no volume or even declining volume. And this one had it, and then it came out with blue bars again, and so it should have been held longer. And then how far extended was it over the 10-day right here? Was 18.7%. So it gets 20% over the 10-day. I may take some off, so maybe could have taken some off there. And then they got killed. I think this was the day the government talked about waiving patent protections or something. So they got blindsided by that. So if I'd stayed in it, if I'd kept part of it, I mean, you can't go back and say, oh, I would have kept all of it, because I wouldn't have. But if I kept part of it, it could have been out, half of what I kept there. And then on this plunge and close below the 10-day and bad news and that big outside reversal bar, I probably would have been out of the rest. And now it's kind of V-shaped. So, I mean, I know it's popped right back up there, but that's not constructive to me. So, that was a mistake. So you just kind of have to do that post analysis. You buying at the open, last minute's the trading day. Yeah, I mean, it can be anytime during the day. If it's a gap up, yeah, I'm doing the same thing personally that I'm doing a group teaching portfolio. So, you know, it's just what it is. So just, you know, pay attention. Yeah, trading, it just depends. It's kind of when it breaks out. Or I may put in the entry, Francisco, at the, you know, if it's an early alternative entry, if it comes through that, those normally don't have the volume signatures anyway. I may go ahead and put in the B1 order if it's a stock I really like. If it's a viable gap up, you know, that 5-minute rule from IBD seems to work pretty well. So when it takes out the high of the 5-minute bar or the high of the 30-minute bar. Because lately the ones that have been getting chopped have not survived that first 5 minutes or the first 30 minutes. So because there's been some gap ups that have just reversed and plunged quite terribly. So let me see if I have any other questions. Got that. Yeah, Victor. No, I really don't have to promote anything. I just give y'all what I think will help. So maybe I could cut that down. I definitely don't do a big introduction to Can Sllim anymore. I kind of just do a quick overview of what we need to remind. But a lot of that's just my reading list and resource list that I list to people, and I just try to add something each month. But I'll think about that because I could do it and link it on the Beat Up site that first 10 minutes or so that I spend doing that. So that's a good idea. Okay, so let's also, I think we wanted to look at some IPO charts, maybe beyond the ones y'all submitted. So let's just pull it up. Let's go to profitable IPOs this year and just see what we get. Okay, so these are sorted by dollar volume because that's the way I like to look at them. Let's see, let's look at weekly. So this is Coinbase. Yeah, daily charts really are better on these IPOs. So I drew, you know, a sloping trend line across, I mean, a horizontal trend line, sorted a watch. This one, doesn't this one have really good earnings and sales? Yep. Oh yeah, 4 green dots. Did I not put those on the chart? Okay, I need to do that. But I know this one. I knew this one had really good earnings and sales. So it's worth watching. This was a direct listing. So it just has that quote reference price of 250. So that's really not even a real price. I mean, nobody bought and sold the stock there. Like with an IPO, whatever the IPO price is, the big money bought, you know, the people that have the institutional accounts that can get in on the IPO, they did buy that much stock at that much price. But on a direct listing, nothing happened at $250. That was just a quote reference price that was a figment of somebody's imagination in the people that advised them or something. So it actually came all the way back down to that quote reference price, has now come back up. Earnings are soon. You know, this one needs some work. That's a pretty deep IPO base. Roblox had a lot of kind of what I thought were dead cat bounces today. This one had earnings, right? Yeah, see, it's still not making any money. I know it's got great sales growth. Somewhere it made money. I have a green dot. Oh, it's projected to make money. Okay, so that's good. It's going to be a turnaround. So this market's just so choppy. Yeah, that's straight up off the bottom. I know you could say that's a short double bottom in IPO, but I'm not in that one. I tried it on the breakout. This was the one that was so disappointing. This was set up perfect. This was just really nice. The price and the volume bars track the cup, the IPO base. This one was great, and then it just fell apart. So that happens, and you move on and keep an eye on it. So DoorDash, that one's looking terrible. Path, this is one, Kathy Wood's in this one. It's a little wide and loose. It did go through. I like this one. Okay, so this one, see, it's got really good earnings again. That's rare for IPO. You've got, yeah, I put the green there. It got the 3 green dots above the earnings, so I put it on that one. So, and that's a really wide bar coming straight up off the bottom. I mean, I did draw a horizontal line and a sloping trend line. Oh, it's got the IPO base now. Yeah, 26% deep. That's a little deep for IPO base. We like to see them 15 or 20%. So, and this market's so choppy, we'll just see what happens. This one, Endeavor. So this is a new one. I'm watching this one. This one has, oh, sorry, let me get the weekly chart. Oh, come on. Market Smith, hang up. So, all right, it has some negative numbers, but it is profitable. And because of what they do, so they're a sports agent, talent agency. They own UFC, the Ultimate Fighting Championship. So, of course, during COVID, they're going to have bad numbers. So that doesn't really kill me on that one. So we'll see what happens. Let's see how many days we got. So there's day 1, 2, 3, 4, 5. It didn't break out there. So today was day 6 of the IPO base. And it's only, yeah, I calculated, it's 18.6 deep, and it has up-down ratio of 6.0. So that's strong. That's good for an IPO. So we'll see what that one does. It has a ton of debt, so that's a little bit concerning. Has good underwriters, Morgan Stanley, Goldman Sachs. You got 22 underwriters, so it's going to get a lot of support. They're pushing that to their customers, hopefully. So we'll see what happened. And it raised 501 million at a 10.3 billion market cap. A firm, oh, trash, terrible chart. I think Market Smith hung up. Okay, App Lovin'. I thought this one was going to be interesting. They help you monetize your app, but looks like it's just being sold. Oh, this one, this is the one I can't even get the IPO line on the chart. It IPO'd all the way up here at 80. So this is just a terrible chart. It is way under that IPO price. Nothing to do. Shoals, a solar company. This one's kind of falling apart. Got work to do. Swim. Let's go to the daily. Profitable. Okay, so it set up a short IPO base and broke out. Some of these pool companies have done well. 1, 2, 3, 4, 5, 6. Yeah, it broke out of a 6-day IPO base. That's a little short. Broke out on day 7. See, this shows it's 46 million, but I'd have to go to my spreadsheet to check it because I know it's lower than that. Double verify 37. See, I'm getting down in the thinner ones. Zim, this one did well. If you got in this one, I didn't. Coming out of this IPO base, this was a shipping company. So it did well, pulled back to the pivot, would not have shaken you out. I mean, you could have sold part of it at the 20% profit goal and sold all of it and maybe got back in when it pulled back to the pivot. I missed it. I didn't get that one. Olo, it's a food delivery app. Yeah, setting up. I can't figure out how this one different than DoorDash or something. Vizio, yeah, choppy, tried to break out, failed. So we've seen that before. Yeah, Zim, I did know they used artificial intelligence. Thanks, Francisco, that they had a little different twist. I remember that from the roadshow. Another pool company. See this one, that's the IPO price right in the middle of the base, but this is a nice little tight little base. I do see a lot of these work. Didn't try that one. So we're down to 30 million. Probably most of these are thin. That one fell apart. Oops, skipped one. Doors Diversify, that one's a cleaning company. I think this one's, doesn't say where they are. I was thinking they're in South Carolina. I think they are. I think they're in Rock Hill, which is where 3D printing is, not too far from me. So OCD, this was the one IPO I tried. See, this one might have been thinner. Maybe that's why we didn't go back in it. So now we're getting down in the thinner ones. So that's a few IPOs. Let me see if there's any other names on here. China. I mean, this is the one I know. see, this one was thin. And so this is the one they covered on IBD Live. So the quiet period expired. It did trade tight with the IPO price. I mean, it traded under the IPO price. That's never good. And then it broke out and then it crashed the next day, came back down, probably stopped everybody out. Then it went up and now it's round tripped all the way back down. And I know this one is thinner. I think it's down around $6 million a day or something. So it, it doesn't have the 50-day moving average line yet. So the volume's off. So this was a total round trip. So that's not good. Priced at the low end of the range. That's an airline, Sun Country. Yeah, so it broke out, went up, failed, round tripped. And again, these are thinner. That's the wine company. So I'm just not, let me look and see if there's anything down here. Joan, this is another one. I think they covered this one on IBD Live. And when it broke out, yep, it broke out. They were covering it. I'm like, it's thin, gotta be careful. I mean, I didn't say that. I wasn't on the show listening. And then it failed the next day. So, I mean, that's two of those that are good examples of the thin ones, especially on the IPOs, are very volatile. So both Joan and Cricket, CRCT, both had problems right after they broke out. And if you don't trade the thin ones, then you just avoid that. And if you look at some of these are super liquid, like Path. Right here, I mean, it's still wide and loose, but this is a very liquid. I'd have to look at my spreadsheet, but yeah, so it traded 5.7 million shares today at $70. So, probably well over 100 million every day, if not higher. So, I mean, Market Smith shows it 296 million a day. And I know that's high, but it probably is close to 200 million or something. So dollars. So this is a very liquid IPO. So there's a lot of funds that are interested in this, had 22 underwriters, 3 green dots. So it just needs to set up. And with the market so bad, I mean, this bar came all the way off the bottom and triggered that sloping trend line and horizontal trend line. And I didn't enter it just because of how the market is. Maybe it'll settle down and form a handle or something for a few days. We'll see. So that was some IPOs. I think somebody else, let me see. Yeah, I wrote down a couple of tickers. So Swim we looked at, TIXT, pull that one up. So, I didn't get it. So this one, I think this one came up on IBD Live today. So this was, this is setting up a nice symmetrical base. I just have a lot of pink dots to remind me it's thin. So it does have a 50-day moving average line. See, it shows up right there, the red line. So once you're 4 days into that, this number down here is reliable. So it's reliable. This only trades 4.2 million a day. So I really like the base. It's profitable. Let's look at the weekly. Yeah, so it's got, I haven't put all the dots on there. It's got 3 green dots. Oh, it just reported. That's why I haven't put it on there. So it's got 3 green dots in this last quarter. It's got triple digit earnings and sales. It's in communications, industry group 77. So at least it's not real high. It's not in the top 40. So this one's, this one's kind of interesting. This would be one of those where, because it's too thin, if one was going to try it, it'd have to be a reduced position size. And it's really about 75% too thin. So maybe that's your guideline. Maybe if you were going to try this one, if it broke out, sort of maybe you just try a 30% position or something. I mean, I wouldn't be trying to find an early entry here in somewhere. I don't want to let it go all the way up. Is it positive for a thinly traded IPO to have a secondary? It's not positive for any stock to have a secondary, Victor. In my dictionary, secondary is a 4-letter word. Sell. It rarely turns out good. I mean, I don't mean that. That's not one of my sell rules, but a lot of times it is. But I do, if an IPO, I do have that rule on IPOs. If an IPO does the early lockup waiver where they do a secondary to let shareholders, insiders sell early, or let the big early investors sell early. I mean, they tell us up front the lockup period is 180 days, but that's just a contract between the insiders and the underwriters, so they can waive that, and they do waive that, and I just hate it when that happens. It almost always trashes an IPO chart. I think Array Technologies did it. Somewhere I have a list of the ones that have done it recently. So you have all this supply coming to market on a stock that's volatile and sometimes on the thin side anyway, and that early lockup waiver secondary, I mean, sometimes they could have a secondary to raise money for the company, and maybe that's okay, but they should have raised enough when they did the IPO. Somebody didn't plan well. But normally what you see is just a month or 2 months down the road, the stock's doing well, and some more of the big money venture capitalists and the insiders want out. So they just strike a deal with the underwriter. Hey, we'll let you take these shares to market. You guys can make a commission. Let's waive the lockup period. And they do it. And it's very frustrating to me whenever that happens on IPOs. And, you know, just generally, a lot of times we see stocks struggle with secondaries overall. All EDR heads are very well connected. Oh, I didn't get the whole message, Marjorie. Zim, yeah, okay, we talked about that. No, the IPO profitable list is my list because I track all IPOs. Is it? Yeah, not to have a secondary. Yeah, so EDR, that's one. Yeah, I did. Endeavor is one I mentioned I was interested in, because again, representing all these sports figures, they're like the took over some classic old time talent agency or something when you read about them on the website. In fact, they were supposed to come public a year or so ago, I think, and they pulled the IPO. Maybe they didn't have enough interest, but they represent big sports stars. I mean, everything they do, UFC, all that was impacted by COVID. So I'm sort of forgiving their bad numbers. I want to see where they can go. Let me pull their chart back up. That was just one. And the UFC stuff is growing. Apparently, I'm not a big fan, but we see it. So yeah, just watching it. You know, had 3 days up. It IPO'd at 24. Now the chart's big enough I can draw the IPO line on there. So it's traded above the IPO price, went up, found resistance. There's your left side high. That's what we want to see. And we just want to see a base. It'd be nice if it just, you know, tightened up, if these bars tightened up and we got a full 10-day IPO base. That'd be nice. You got good underwriters. Oops, make that a little bigger. Oh yeah, this is the one with 22. You got a lot of underwriters. Man, that's a ton. Oh, now it made it disappear. There it is. Yeah, so that's a lot. But you got Morgan Stanley, Goldman Sachs. You got all the big ones in there. So that's always positive. We like to see that. You hope they'll be pushing it out to their customers for a long time. So we'll see. Yeah, but talent and sports, these guys really would have been impacted by COVID, and hopefully will really be ramping things up as they come out of it. Yeah, so you can see even leading up into COVID, look, 5 cents a year, 13, 15, 2019, 35 cents, 2020, they get hit by 2/3. So that just makes sense to me that their business would have really been impacted. So we hope it's almost a reopening play to keep an eye on that one. Okay. Oh, Hollywood agents. Gotcha. But wait, what were you saying about that? I have to go back to your other. Oh, very well connected. Yeah, the impression I got from watching their roadshow was they were a big deal talent agent. So that's good. Yeah, Array. Yeah, thanks, Michael. I thought Array was the one that had a secondary. And, you know, back in the day, that happened with there was a clothing company that did well, Michael Kors, the guy was on TV. So they just kept doing secondary after secondary after secondary and just kept hammering that stock. It would get going and they'd do a secondary. So that's pretty cool. Well, that's good, Marjorie. You know something about that one. So we'll keep an eye on it. You help us stay up in touch with Endeavor and what they're doing. And on these, I mean, y'all know MarketSmith makes it easy. They tell you what industry group they're in right there. All you have to do is click on the company name and it takes you right to their website. So, you know, it's not hard at all to do a little research on these. Let's see what their story is. William Morris Agency. Yeah, so they went all the way back to 1898. That's what I thought. Had Elvis Presley. Yeah, so cool story, you know, cool little timeline. They're big women's tennis. I think they're really tied into that. And then here, you know, to me, that's sort of a game changer is buying UFC. So on Fortune's list, yeah, so that you can read about them and see what they do and who they're connected to. So you can find that out. So I just thought they were interesting. And what they do, so they raised $501 million at a 10.3 billion market cap. So just still setting up. And even if we miss an IPO base breakout, if it's a true market leader, it's going to go form a stage 1 base. We're going to have a chance to get in it later. So it's sort of good to track it while it's young, I think. Yeah. Oh, Steve's talking about, yeah, it depends. Yeah, because some companies, what Steve's saying, I do look at when a company announces a secondary, why are they doing it? If they have a bunch of new business and they need to build a new plant and they need more cash, that's a great reason to have a secondary. But if they're an IPO and all they're doing is letting the insiders sell early, who previously told us they weren't going to do that for 180 days. I mean, that's what really gripes me about it is you put in the filings, we have a 180-day lockup period, but then there's this little asterisk that says, just kidding, you know, we can change it if we want to. It's not an SEC rule, the 180 days. It's just the underwriters and the insiders, because the underwriters don't want that flood of shares coming to market early because it can kill a stock price if you get a bunch of supply dumped on the market. And see, that's what happens with the direct listings. That's the problem with the direct listings. The sales are all by existing shareholders, and normally on direct listings, there is no lockup period. So all those people at Roblox or Palantir, I think Palantir was a direct listing, they can sell at any time. There's no restrictions on them. And we all know the stock market's a law of supply and demand. So if you ramp up supply too much, you're going to drive the price down of oversupply. So that's why I don't like them. Yeah, down the road, secondaries, they don't kill a stock like that early one on IPOs do. And we do need, as Steve pointed out, we need to look and see what they're using the money for, because that makes a difference. I've not seen one on an IPO where they waive the lockup period to do an early one. I don't have one of those that I've ever seen that benefited the public shareholders of the company. I mean, I think they all got hit and took a while to recover. And Steve and I have a pet stock that we kid about that did that. The stock was Airgain, AIRG, is still around. It's thin now, but it IPO'd. We were both in it. It was doing well. And I swear, it was the Wednesday after the market closed before Thanksgiving, if I remember correctly, that they announced they were waiving the lockup period and letting the insiders sell and do an early secondary. And I thought it was illegal. I'd never heard of it. That's the one where I learned it's like, oh, this is not a SEC rule. They actually can waive this and do this. And I was so mad. I sold that thing immediately as soon as the market opened Friday. I probably sold it in pre-market. I was like, these idiots, because I could see it was killing the stock price. And still, I had a good gain, and Steve had a good gain. But we do laugh about it. Whenever it report earnings, I'll send him a note and said, hey, your favorite stock's reporting. You might want to get in before market opens. And we don't do it. We leave it alone. What's their chart look like? But I mean, really, the Wednesday before Thanksgiving, after market close, you announce that. I was just like, that was really underhanded. So that one's an inside joke between us, but it's still around. There it is, Airgain. Go back to a monthly chart. Yeah, so I hadn't done well. This was probably that run up. Yeah, and this was probably, right around Thanksgiving or whatever, somewhere in there. So we were trying it, we were in it and made money, probably made more than the 20% profit goal still, but it's been crushed since then and it just trades thin. So um, it's not anything. Yeah, gold has come back. Oh, they just reported earnings. They did actually report good earnings, good numbers. But if I remember, yeah, 378,000. Yeah, so it's under $10 million a day. So it's thin. Um, so nothing to do on it anymore, but we laugh about it. The plus or minus of pre-market or post-market buyers, that's really hard. You just have to decide. I mean, a really good market, if you'd have to go back and get my recording from November, but on buyable gap ups, I like stocks that have formed a full base that's on the Market Smith chart, and they are gapping into or just past the blue buy zone. That's my favorite setup, preferred setup for buyable gap up. So if I see that happen and it's a Can Sllim stock and it reported great earnings, sometimes I'll buy some of it pre-market if I can get it right at the beginning of the blue zone. I mean, I want to go, you need to look at the numbers, and if they reported the evening before, Seeking Alpha will normally have the conference call transcript up overnight for free. So you can go read it and see what they said in the conference call and see how it's reacting. But I'm not real good. Some people are real good. Steve's good on studying the bars and the price and volume, and sometimes we'll enter before market opens too. But it's kind of hard. I mean, the IBD rule on buyable gap ups, they're saying, and it seems to be a pretty good rule, they're kind of saying wait for the high of the 5-minute bar and then start your position when it passes that 5-minute bar, or use a 30-minute bar. And that would have kept you out of a lot lately that failed. In other words, it never came above the 5-minute bar. It had an initial gap and it started coming down. So particularly in a bad market, seems like maybe that's a better way to do it, or a good way to do it. So you just have to build the experience and to see how it works. Okay, Andy asked, how do you analyze the price? I have no idea. The underwriters, it's just like, how do you set the IPO price? They set the IPO price based on what they think the market will bear. So the same thing on the secondary price, they don't want to undercut the existing selling price too much. Otherwise, they're going to say, oh, all the new owners think this company's worth 20% less than what it's selling for. So they have to take into account the stock price. So it's usually within a few percentage of the stock price where they think they can sell X number of shares to new big money buyers, because that's who's buying the secondary. They're going out there saying, hey, you can get a deal. You can buy this 2.5% under the current market price and get all you want. And so they're happy. So you just have to sort of deal with that. I mean, just generally, if you're in a stock and it has a secondary and it doesn't trigger your sell rules, then you can stay in it. It's just, I do, again, on the IPO ones, I've just seen them all be so bad that I do have a rule. If they announce they're waiving the lockup period, I'm just out. I mean, that's a sell rule for me on waiving a lockup period secondary, but that's only in the first 180 days of the life of the company. So those do not happen that often. Okay, let me switch. So I did a list. Well, I'll do two things. So first, here was my watch list from last weekend. So because these financials and all are doing well, I mean, I forced myself to put these on some of my watch list. I tried to pick what I thought were the best of the best. This one is on the sector leader list in the paper, which is usually a pretty good list. So that's probably why I sort of picked it. But you can see, so it broke out last week above this horizontal trend line. I'm not in it, and then had bad day today. See, today a lot of the financials and the cyclicals had bad days. This one didn't work, gapped up, broke out. In fact, you'll see in the group teaching portfolio, I actually tried this one on the second day and got stopped out immediately. So took a loss, didn't work. PXD, so this one broke down. I mean, the market's so weak, I didn't try any of these, but this was my top, these top 8 Usually I don't have that many on my top tier. So Evercore didn't have a good day today. Calix, what's this one? Communication systems. Okay, well, that broke down. First day of the week. IDEX. I do like this one. This one's been on my watch list for a couple weeks, but it's, wow, that the handle has fallen apart. I mean, fallen apart by it's gone super wide and loose. Let me look at the numbers. I was hoping this one would have an earnings gap up. Yeah, see, this is a good stock. It's got 2 green dots, it's got strong earnings and sales. It's liquid, 222 million. Oops, let me hide this. Let me see. So it's got 3 top rated funds. There's T. Rowe Price. Remember, I told you that's one of the ones I like. Fantastic return on equity. Pre-tax margin's good. Has 135% debt. Like to see under 100%. Yeah, 8% off its high. It looks all right on the weekly. Yeah, the weekly chart kind of tightens up all that mess for us, doesn't it? That's why we work out. Look, you got 3 weeks tight in the bottom of the base. That's constructive. The base barely formed under the 50-day, so that's okay. Yeah, I like this one. The RS line's lagging. So they do vet products. Industry group 82, so kind of in the top 80ish, not in the top 40. So I did like this one. This wasn't one I forced on there because it was in the oil or gas or something else. NTR, this is one of the fertilizer ones. Let's see. Yeah, it's still in the buy zone. Again, the market's so weak. And then I put Goldman Sachs on there. So that was the top list. And then those of you who sent me tickers in advance, I put on this list. So part of this, I put April and May meetings. So these are all the ones we looked at last month. So I'm not going to go back. Well, let's just go through them on the weeklies real quick. So a month ago, these were the stocks y'all said, hey, we want to look at these. So come on, Market Smith. There we go. Okay, so that one round tripped. We already looked at it. Floor and Decor, broke out, was pulled back to the 50-day, may trigger a stop loss rule. You have to keep an eye on that one. Roblox, okay, we looked at that one already. Roku, former leader, under a declining 50-day, nothing to do, trashed. Etsy, former leader. I mean, these former leaders from last year, again, I have a graveyard of 2020 leaders list, literally. So this is another under declining 50-day. There's so many people trying to trade the stocks that were leaders last year, and I just see them getting stopped out all the time. Down under the 50-day. Progeny, I was hoping that one would work, but it's broken down, failed breakout. KLIC failed under declining 50-day. KLAC failed. These are the chips. A lot of these are the chip stocks, and it's really weird that we have this massive chip shortage and the chip stocks aren't working. And again, that's why we go by the charts, because the charts are telling us they aren't working. This one is similar to Trade Desk, crashed and burned, round trip. Qualcomm, under the 200-day now, ugly. And then that's my divider. So here's the one y'all sent me to look at. So isn't this one? Yep, Chinese. So that's kind of a problem. It's back near an all-time high. You just don't know if you can trust the numbers. As expected, no top-rated funds. Let's see if it has any of my flag funds. I bet it doesn't. So I just click on that little flag, and it should pull up a down arrow. Yep, and it sorts them. So no flagged funds either. And really no surprise to me at all. I mean, it's liquid. It's just, there's nothing it's not actionable now. I mean, here's the base. It is broken out. It hit the profit goal. It actually went up 55% within 3 weeks. If I had owned this one, there's some strong buying. Look at that. 1, 2, 3, 4, 5, 6, 7, 8 weeks up in a row. And look, it closes at the top of every week. So some money, and look at the volume bars. That's nice. There's some money flowing into that. So if I'd tried that one, I probably would have been selling some up in here, and then as it came back down, it round tripped almost back to the pivot, probably would have been out. But I don't like Chinese companies very much either. Cleveland Cliffs, okay, this one's extended. I think we were in this one in the group teaching portfolio, got stopped out, broke out. So I like to see it form a new base if it comes down and triggers a triggers that. Has real low ROE and pre-tax margins, so I don't like that, but has really good earnings and sales. What are they? Oh, steel producer. Okay, so they're in that rotation group. RS line's going up. FCX is this sort of similar. Copper, gold. Yeah, copper. I've had a couple people mention to me that electric vehicles have X number of times more copper in them than regular combustion engine cars. So this broke out of a double bottom base. It's at the profit goal. So if your rules are to take some, I mean, I don't know if you would treat this one as a true market leader. Boys had a big run up. It's gone from 6 to 40. So it's up sixfold. Yeah, I'd probably be taking some off the table. It's sort of that, how much more is it going to do? Like David Ryan talks about it. TSM, okay, Mike Webster says never buy or own a stock under a declining 50-day moving average line. I tend to agree with that. So this one just has an ugly RS line too. This one just needs work. Very liquid, 1.2 billion a day. You got Fidelity Contra Fund in there, so you have some fund ownership. It's just not actionable, nothing to do. It is a foreign company, so you would keep that in mind. The annual growth's not that great. AD's D minus, up down's 0.6. Yeah, these are really low. It doesn't surprise me the chart looks bad. Composite rating 76. You know, we kind of like to have that above 90. Industry group 150 out of 197. Yeah, a lot of that one's not actionable to me. Rio is one David Ryan talks about. Yeah, so it's just broken out, stage 2 base. It's only, see, it just about a little more than doubled off the bottom. So it's one of those that maybe can run some more. And it's in that mining group that's industry group 21. Yes, doing well. Doesn't have Can Sllim sales, but you know, if you're in it, I guess you just stay in it till it triggers a sell rule. Doesn't have any top rated funds, but these mining companies, they're not going to. These aren't traditional growth companies. Tech, Canadian miner, little bit extended, just 7% extended. Stage 3 base ran up from 6 to 24. Good numbers. Sales are light. ROE's light. 135 million, so it's liquid. Yeah, this is one of those, didn't build a lot of volume coming up the right side of the base. It did on the breakout day. Yeah, if that one was on your watch list, oh, it must, I think it was on my second tier watch list because I have it flagged this week. So, yep, somebody had asked me about that. And then MTZ was the last one somebody sent me in advance. Maztec, oh, just extended. Their question was, what happened when you miss the proper buy point and the stock goes up? We commiserate together because it happens. This one really, here's the cup, and maybe as it came back to all-time highs, maybe somewhere in there, has good number. Of course, back in here, what were his numbers? Yeah, see, it didn't even have good earnings and sales back here. It probably wouldn't have been on your radar. Even back in here when it broke out. It's just because the money has rotated to this group that this one worked. And we just have to learn. David Ryan said this, Scott O'Neill said this. When they first started, they made a lot of mistakes. David Ryan lost a lot of money, gave a ton back, and took a weekend, and Scott O'Neill kind of did the same thing. Went through all the charts, marked them up, and they both were making the exact same mistake. They were buying stocks extended. So they were getting past the 5% buy zone. Maybe you can go a little bit past it if you're good at keeping your losses short. But I'm pretty good at not chasing. If they go on, I just have to go, you know what? It's going to be another boat coming down the river. Last year, just because you missed Livongo, it doesn't mean you didn't get Teladoc. Like Kathy Donnelly was talking about recently, you only need one or two really good ones a year and handle them right. to do well, like BNTX. I didn't handle right. I sold it too soon. So, I mean, this has a nice art. This all looks good. It's just not actionable. It hasn't set up a base. It hasn't given, you know, if you were in it down here, here's the first pullback to the 50 days. So to me, that's an add-on buy point, but I don't initiate there. Now, Charles Harris might have been buying it there. You know, he'll buy on weakness. And so he could have done well. It could have been in at 85 and it's at 120. Okay. So it probably got to the 20% profit goal right there. But I'm not good at initiating on those pullbacks. I like adding there if I'm already in it and have a big cushion. And if you're already in it, look, there's a 3 weeks tight. So you could have added there. And if you added there, you probably wouldn't be up enough to add again. I mean, I've used Lee's rule that you need to be up 6% on your last buy before you're adding. So if you added off the 3 weeks tight, you probably couldn't add here because this wouldn't be up 6%. But if you miss this, then you could do your add there because you're up 6% from where you initially bought. I mean, the best thing I know is go back and study those 70 charts from Bill that I put together for you, because that really showed how he traded the true market leaders over time, where he added, when he didn't add, when he rebought a whole second position. See, it would have been just nice if the stock had stopped and formed a second base. It never really did. So that was kind of tough. I hope that answered the question. And then let me see if I wrote down. So somebody wrote down at the beginning, ticker Cyber, CIBR. I can't remember. Is this an ETF? Yeah. Okay. So this is one of the cybersecurity ETFs. Yeah. And so I should have been prepared to talk about this, but we didn't get to the ETF segment. I will tell you. So IBD just did a new webinar on trading ETFs. And so a lot of the materials I was going to teach, or part of the concepts I was going to teach, came out of that. So you can go watch that. They talk about mean reversion and maybe your entries being a little bit different on pullbacks, rather than like you're not expecting an ETF to form a regular base. It might, this one did, but they talk about some different buying strategies. So go watch that webinar. It's under the webinar page. It's one of the last 3 or 4 that they did. So Hack is another, you know, the ETFs usually have good names, like PB&J is a food one, peanut butter and jelly, and MJ and POTX are the cannabis ones. Yeah, so Hack, yeah, so these haven't taken off, or didn't get a bump from the pipeline. FireEye, yeah. What's the one? PANW. This one was a true market leader. Palo Alto, yeah. So this was a great leader back here. Wow, it's really led in this market. And then it had a nice run here. It actually came back and led again. So, all right, let me go back to the question. Ooh, maybe triggered a lot of questions. Yeah, Steve's going to eat. I don't blame him. Chip shortage. Yeah, SCCO, Yeti, SCCO is the copper play. And there's a couple copper ETFs too. What do they talk about? What do they say? What's the old saying? Copper's the metal with the economics PhD. Like it's a leading indicator of or an indicator of being in a good economy. Yeah, so okay, that's a stage 3 base, but it's set up 23% deep. Oh, good numbers. Yeah, 3 green dots. RS line's going at new high. I drew a sort of horizontal trend line entry. Must be on one of my lower tier, not on my top tier watch list. Let's look at a daily chart. Yeah, so tried to break out, got rejected, came down, trying again. Yeah, here, that's kind of the entry I like right there. You'd still even be at a slight profit. I mean, I think the copper ones are worth watching. What's the ETF? COPX, or maybe this is the copper miners. Yeah, oh, same thing, already at the profit goal. So that one's extended. Maybe COPR. No, not a real symbol. Okay, I think there's another copper one. And somebody asked about Yeti. whether it's a true market leader. Let's look at a weekly. Wow, definitely had a nice run, 16 to 80 off that bottom. Not that we're ever buying down here. I'm just looking at how far it's gone. So coming out of the pandemic, this one obviously got some traction, stage 1 base. Yeah, I don't know. Let me put it down here so I can see the numbers. Good RS lines, angling up. Oh, great return on equity. PTM's good. Debt is small, 109 million per day. Oh, good fund ownership. So you got Lord Abbott in there. Let's see what other ones we have down here. Didn't pull up any of my flag funds. That's okay. I mean, you got 4 of the main ones, so that's okay. Yeah, I would want to read a little more. Yeah, if you got it in here, you'd say, yeah, this may be a true market. Because when you put it in true market leader category, I mean, you're saying, hey, I want to try to hold it for a decisive break of the 10-week line on volume. So, I mean, one of the problems is you may have, if you got in it here, you may have, no, you don't have really high volume. Maybe you would have held it through all this mess and still be in it. But that's the thing, you're using a different sell rule for it. You're transitioning it to that. And I mean, I know they have a strong brand, sell a lot more cups than coolers, but okay, so FCX was the other copper one. Oh, okay, got it. Copper, gold, silver. Yeah, okay, so they're a miner, right? So they have copper in there with some other ones. And yeah, and so it's extended, so nothing to do. I mean, I'm pretty much going to look at charts and say it's extended, nothing to do. You do have to pay, I will show you one thing, ATKR. So this one kind of snuck up on add-on buy rules, and I've covered those in prior webinars. So one of the add-on buy rules that I'll use is being up 12 of 15 days. And so sometimes that sneaks up on you, but this stock was actually triggered that rule that day. And I think this day, or maybe these two, I can't remember. I'll have to go back and count. So I didn't add. You don't have to add. The market's kind of screwy, so it's come down below that now. So maybe if it comes back up through it, could add 20% or maybe reduce it down to 10% of the shares held. So I was just pointing that out. I put those gray arrows on there just to say, hey, that one was up 12 of 15 days, which is one of the add-on buy rules in Lee Tanner's set, which is the set I use for potential add-on buy rules. You just don't have to take them, and the market was getting so squirrely, but this is one I'd like. I mean, so this is in the construction group, good industry group. So, it's in that group that's moving unless they all get hit. So we'll just see what happens on that. Okay, let me look at this. Yeah, the FCX, we got that. And I think I got all the tickers you guys sent me. So if that's it, we will wrap this up. Next month, I'll come back and do the ETF segment, which was a little shorter than the Can Sllim, and I'll also do the a little bit on the wash sell rule because that's coming up. Those will both be shorter segments, so I'll get both of those in next month. I was just a little too aggressive. Okay, AZEC, they're getting ready to have. Well, first let's look at Trex because they're a cousin to Trex, and Trex just reported maybe yesterday. I remember him talking about it on IBD. Yeah, so was kind of setting up. Okay, so it doesn't really have Can Sllim earnings, so that would sort of be a concern. So AZEC, this one's a recent IPO, and earnings are due in 2 days. So really nothing to do ahead of earnings. Let's go put it down here so we can see the data on it. So return on equity, go to a weekly chart. 10, pre-tax margin, 15, debt, so 37.9 million. So it's got a 50-day moving average line. So we know that's almost 40 million in volume. This has good fund ownership. So you got Fidelity contra fund in there at 0.02%. Okay, so let's see if we get any other Fidelity funds. We open this down here. Yep, okay. So it has 3 that I flagged, Fidelity. Let's see how many more we get. Let's sort them alphabetically. And oops, oh, it takes a minute to load because it's a long list. So you got 646 funds in there. So yeah, look how many Fidelity funds are in there. So that's what I said. When you see Will Danoff in there, even if he's just starting at 0.02%, some of them, there's a lot of Fidelity funds in that one. Yeah, so that happens. So that kind of bears out what Ropel said, is those guys all talk, they all work for the same company, and so they've got it interested in this one. So this one has very good fund ownership, very good numbers, accelerating earnings and sales. Yeah, this was just one just watching for earnings. So now it's pulled back before earnings, very light volume. Oh, sorry. Let's look at the daily chart before I say that. Yeah, bad day today. Was in the buy zone, but so if you had it before earnings, you're probably not going to have a cushion. You know, if you bought this breakout, you're going to have to exit. So just watching the earnings and seeing if you get a buyable gap up on that one. I mean, we know construction is going crazy. We know the Trex decking is more expensive than wood decking at least 6 months ago, maybe the same price now. So these guys may be ramping sales just because they are now not as expensive an alternative. They're slightly more expensive, but not as much as they were for decking and everything. And if you get permanency because of that, then maybe that's a good thing. You know, the RS line, we'd like to see that go to new high with price, but yeah, I think this is one to keep an eye on. You know, a lot of it's just dealing with the market right now. Yeah, Francisco aluminum. Yep, the metals, the steel for, you know, if we're going to get an infrastructure bill for bridges and all that, and all that's got to be transported. So the railroads, you know, a lot of the non-traditional growth industries are going to benefit from that. And so we just have to be aware of that and sort of pay attention. So that's it. I appreciate everybody showing up. I will try to get out the slide deck and the recording tomorrow, so you'll have that. And if I don't get my mutual fund list uploaded this week, I'll try to get to it sometime this weekend. No weekend update this weekend because I'm gonna be over in Hiawassee, Georgia. It's right on the North Carolina-Georgia border, cooking in a big green egg event. So if anybody's over there Saturday and goes to the event, stop by and say hello. We'll be easy to find. We're in the Tiger Paw tent for Clemson. So I think that's it. I'm gonna stop the recording. I'm gonna go back through the questions. So I'm gonna stay on for a few minutes, but I don't need to record it.